Welcome to the Foundry, where leaders are forged daily. I'm your host, George Roberts. Hello, entrepreneurs. Welcome back. This week, we interview Paul Shannon, founder of Red Hawk Real Estate. Welcome, Paul.
Thank you, George. Thanks for having me on.
Well, it's great to have you. And I'd like you to kick it off by just giving us our background, telling me what you were doing before you got into real estate, and then how did you merge over into the world of real estate?
Sure. Yeah, I'm originally from Boston, Massachusetts. I've got three children, 8, 6, and 2 girls and a son. My wife and I live in Indianapolis now. We've been out here for about 7 years. We moved all over the Northeast and the Midwest for our careers. I spent my career in sales. Like a lot of people coming out of college, I wasn't sure what I wanted to do. And I was a people person, so sales seemed like a good fit. So that's where I started and kind of ended in my W-2 role. But I worked for a number of different companies for the last 8 years of that run. I was 17 years in sales. I was with a medical device company selling capital equipment, implants in the operating room for cataract surgeons. So a lot of early mornings in the operating room. I'd get out early afternoon, make some more sales calls, typically drive to another location where I'd be staying in a hotel, getting up early the next day to kind of do it all over again. So did that for as long as I could mentally handle it, and got into real estate sort of through getting over analysis paralysis and realizing that lifestyle that I was living was not the one that I wanted long term. And I saw real estate as a potential outlet for that, to potentially find something that I was passionate about, that I enjoyed doing, that I put off, but also as a supplement to W-2 income and long-term wealth building. So I got into real estate in 2018, and 2019, I made the decision to leave corporate work.
Right, great. So like, just can you walk us through that moment? So you're out there, you're a sales leader, you're busy all the time on the road, and you're just contemplating that future, and there you
Yeah,
have it, right?
yeah, it was, the decision didn't come easy. Let's put it that way. I mean, there was a long time where I was grinding and realizing that, I have to do something, but what is it that I'm going to do? That answer wasn't very clear for quite a while. I really just needed to take action when it came to real estate. I read enough books, I'd done enough networking, I'd studied enough to know the basics, but you get so much from being book smart. You really learn when you're out in the streets and get street smart. So through taking action is when things started to materialize a little bit more. I bought a duplex in 2018. It was an older property. It came with tenants in it. So I got a little bit of experience with leases, working with tenants and just understanding their concerns, maintenance calls. It was an older property, like I said, so there was a lot of issues that would arise that needed, contractors to attend to. So made some relationship with contractors that way. And I thought, hey, this isn't that bad. Let's take a next step here and let's do a full rehab. So I bought a single family home, and it was a 1955 build. It needed quite a bit of work. It needed to be replumbed. It had a roof that needed to be replaced. The entire interior needed to be gutted. So that was a heck of an experience for me. And that was while I was working. So I wasn't able to be there on the job every day. I hired a contractor who I thought was going to be good, who ended up being kind of a train wreck. Guy was partying there more than he was working half the time, spending the nights, inviting friends over. Cops got called one night. So, all the horror stories you hear about things that can go wrong, that usually scare people away, kind of happened to me. But I came out the other side and was successful with this deal. So I put 55,000 in to buy the place. I put about 30 in on the rehab, and then I got appraised for 145. So I pulled out all the equity that I put in, my own cash, plus another 23,000 or whatever it was, on an 80% LTV loan. And that's kind of when the light bulb went off that, hey, this is something that I can scale, something that if I dedicate 100% of my time to, I'm going to become more efficient at and gain some economies of scale as well as some proficiencies. And all the nightmares of, that 3-month period where I was rehabbing this place, I still wanted to do it, which I thought, is there something wrong with me? Maybe it was that I wanted to run away from my W-2 work that much that I was willing to take on anything else. But in actuality, it worked out really well, all said and done. You have to learn by taking the school of hard knocks route, really. And that's what I got, was an education by going through this. And I haven't had as bad of an experience since. There's always challenges with rehabs and dealing with contractors and tenants, but you get better at it and you understand it, you figure it out. And then from that point, it was kind of a way I went. I decided to leave W-2 work and pursue real estate full time.
Great. So you had at that point a couple of deals, and then so I always like to figure out, did people wait until they fully replace their income, or is this something? It sounds more like you're seeing, hey, this is working. Why don't I just go into it and become more efficient?
Yeah, yeah, absolutely not. I mean, with a duplex and one single family that I had
Yeah.
rented out for 1,200 a month, I wasn't replacing anywhere near the income I was making in my work. So it was more of a, hey, I'm going to take a chance on myself. And what better time to do it than now? You know, I'm 40 years old. At that time, I was 37, 38. And I thought, well, hey, I've got a good skill set here. I've got a career that has been successful. I could always fall back on that. I could always go back to that work, whether it's with that company, which I was, invited to go back to do. I was actually called shortly after leaving, and they wanted me to come back as a 1099 to help out with a woman on our team, or my team at that time, that was going on maternity leave. So I maintained a really good relationship. That didn't work out for tax reasons. Otherwise, I would have been happy to help. But yeah, it really was a situation where it was like, hey, let's go all in on myself. Let's give it all we have. I'm going to give myself 2 years. And if I can't get to the point where I feel as though I can grow this into a real business, then I'll start to look back and say, hey, maybe I should think about doing something else. But fortunately for me, that hasn't been the case. And I love what I'm doing, and just continue to grow.
Great. I love it. So just onward and upward from there. So then why don't you take us through your time frame? So this is all over the last 3 years, right? So you start real estate, soon thereafter, you're quitting the W-2, and then next thing you know, a year or two later, we're in the pandemic.
Right. Yeah. Great time to leave and take a chance. Right. And then all hell breaks loose. So, yeah, that was a stressful time. So, leading up to the pandemic in 2019, I bought, I think it was 19 or 20, 22 properties, something around that number. Some of them were ready to go and came with tenants and were pretty low maintenance. I bought some from investors, some from wholesalers, a couple REOs, a couple auction properties at sheriff sales. So I picked these things up in random ways. Um, I bought some as packages where I would get like 6 at a time. Um, so I was kind of accumulating some, and some of these were projects where I'd have to go in and do full rehabs as well. So a few of those that were heavy rehabs, heavy value add deals were quads. I had 3 vacant 4-unit buildings, so 12 units total, and was kind of halfway through renovating those. I had one that was done, that was getting leased up, and then we had started on a second one. A third one was vacant. This was around March of April of 2020. So that's when obviously COVID and all the hell really broke loose, and there was a lot of questions up in the air as to where we're going to be as a society, and are we ever going to come out of our basements again? And it did make me nervous. So with rent moratoriums and kind of uncertainties like that, I moved ahead. We were able to finish the projects. We did have some slowdowns because we couldn't get work. Contractors were not showing up and not working. So it took a little bit longer, threw us off a little bit. But surprisingly, as we approached June, July of last year, the market was a lot stronger than I anticipated it would be. And I thought, well, hey, let's take something off the table here. Let's divest a little bit. I connected with a wholesaler that had some out-of-state buyers. And she said, hey, let me put it out there and see if anybody's interested. And a group came and made a nice offer on it. And I ended up making a 6-figure profit on these 4 units. So I held on to the cash and thought, hey, this is good for an opportunity fund or to buy more real estate down the road or whatever it might be. But right now I've got enough uncertainty and I'm a conservative enough investor that I just kind of want to sit on the sidelines and see how it pans out. Call it the fall, maybe September or so of last year. I start to realize that, hey, all this money that the government's been pumping into the market and into the financial system is potentially going to create some problems with inflation. So, where would I want to put my money if inflation were to be a concern? And what better place than real estate to park your cash? So I'm thinking, rent moratoriums, all the disaster situations that maybe could have happened didn't end up happening. So I kind of got refocused. And my initial intent, before I even bought the first duplex I owned or the first single family I owned, was to get into apartment investing. And I didn't have the confidence before I had some experience going through dealing with tenants and dealing with contractors. And, call it like a mental hurdle or just something that I had to kind of go through from a milestone standpoint. I know there's people that go out there and they buy, big apartment buildings on day one and they're successful in doing it. That just wasn't me. I mean, I was the type of guy that I had to go get my real estate license that I've never used before I quit my W-2, just to say, hey, I understand this business a little bit more academically, and now I'm ready to take that next step. So very methodical and slow. But I got refocused and I thought, hey, this experience I have, I'm ready now. I'm going to leverage that experience and I'm going to go attack and try to get an apartment complex. So at first I was trying to go to brokers and having limited success. I had a good story to tell, I thought, but the market's a little bit crowded right now. And there's plenty of people out there that have closed deals and are closers. And, I didn't have a track record from that standpoint. So got a little frustrated with that for a little bit and then decided to kind of go around brokers and make it happen myself. So I started doing direct mail. I would drive for dollars, literally knock on doors sometime. Hey, who's your landlord? That type of thing. And I came across a property. It was a 40-unit building in Evansville, Indiana. The seller was your classic distressed seller. She had some health issues and had run out of money, was undercapitalized when she came in on the deal in the first place. And she had put a lot of money into some of the CapEx items that don't drive NOI, which I appreciated, of course, like the roof and HVAC and such. But really the property was falling apart and she needed to have an infuse of capital. And she couldn't find somebody to do that for her. So she realized that she needed to let it go. So I worked directly with this person, and it was an arduous negotiation process. It took months to get the deal done and a lot of back and forth. And I didn't think it was going to happen many times, actually. But we were able to always come back to the negotiation table, and eventually we got it done. So I closed on that at the very beginning of this year. And I'm repositioning the property now. And I hope to have it done here in the next couple of months. We're about halfway through 175,000 or so rehab.
Yeah, I love it. And so the first rule in any real estate program is you got to buy right. So it sounds like you had that opportunity to go in there and be a problem solver.
Yeah, I think it was. And that was what I was looking for, was to kind of deploy the same strategy that I had used on single family homes, the Burr method, if you will, to find a property that I felt as though I could add value to and increase the valuation. So then I could go ahead and take some of that equity back out and roll it into more properties. So what was nice about it is the bank, or the credit union actually, that I went through to get the loan, they did a as is appraisal on it in the condition it was in when I acquired it, but they also did an after repair value based on the renovations that I intended to do with contractor quotes that I had submitted, et cetera, et cetera. So the appraiser was able to look not only at what the property was today, but what it would be in the future. And I knew what it was going to be worth. And it validated my kind of value add play that I was going for with the apartment. And knowing that ahead of time before you close was another big boost in confidence that, hey, this is a good decision. Let's go for it.
Right. So you've been through a lot of transactions in single family, and that's a huge benefit, I believe. Now how did you finance these? Did you have to go through creative financing? Obviously, I think you said at one point you had over 20 properties. So you obviously go way beyond what you can do with conventional loans. And then, as you mentioned, you're getting into the credit unions at that point.
Yeah. So on the single family side, when I was first getting started, we had the benefit of having equity in our primary residence. So I used that money. I tapped that immediately. And that's how I'd buy properties, on short term, with the short term mindset, I guess you could say, with the intent of, once they were done being rehabbed, to finance them into long term debt or just keep them free and clear. So that's what I did. I went through a couple iterations of lenders. There's a company, I won't name the name, but they finance in the name of an LLC as opposed to financing in my personal name and then doing a quick claim into the LLC. I know a lot of investors do that. For me, the due on sale clause was enough to just say, you know what, I'd rather do it right. So if ever there were a liquidity crisis and banks wanted to call back some money, I wasn't going to be the first one on their list to call. But I paid a higher interest rate for that. I was paying in the sixes. So in today's market, that's ludicrous. But they still cash flow really well. I've got a handful with lenders like that. I kept some properties free and clear, and then I took out a business line of credit on those properties to have extra firepower to buy larger acquisitions, or just to have some additional reserves if there were a liquidity shock. So there was that component of it too. I did raise some private debt from some of the contacts that I have from my past career. So we've got a situation set up where, these are older folks that are getting closer to retirement that are just really looking for yield. If you look at today's market, the risk-free rate of return, or the return-free rate of risk, if you will, on the 10-year bond is 1.6 or so today. There's really not a lot of money to be made there, not a lot of yield. So what the monetary and fiscal policymakers have done is they've pushed retirees farther out on the risk spectrum to get yield so they can pay for their lifestyle in retirement. So believe it or not, there's a fairly large group of individuals out there that are pretty happy with 6% returns. That's maybe for you and I a little bit less than we'd like to get, not enough to blow our hair back, but 6%
I charge
is
12
decent.
as a hard money lender.
Yeah, there you go. So yeah. So, but these are people that know, like, and trust me. I know, like, and trust them. So we have somewhat of a relationship, and they're making a return that satisfies their requirements. And they're also helping me out. So I did raise some money that way, and that was really helpful as well. With this transaction on the apartment side, that was done through the credit union, the same credit union that I used to get the business line of credit on the free and clear properties.
Yeah, and so that's recourse then.
It is recourse. Yep. Yep.
And I think I remember you mentioning to me at one point off camera that that transaction is about $1 million, right? So pre-renovation, that's something that's very difficult to get non-recourse anyway. But I'm sure your ARV is probably going to get you well into that.
Yeah, it should. I should be able to look at like a Freddie Small Business Program or something like that. The challenge will be is if I will have a prepayment penalty if I refinance outside of the credit union, and they've already given me the appraised value before I bought the property for what it would be after repair. So I kind of already know where I stand. I don't need to pay for another appraisal. I don't necessarily even need to pay to refinance. If I wanted to, I could keep it with this credit union and collateralize the equity that I have, or collateralize the apartment and use the equity that's in it and roll it into another property. So they kind of be tied together. I'm not sure how I feel about that at this point, whether that's, risky, or it does limit my ability to look for financing outside of this credit union if I were to get a property under contract, as opposed to actually refinancing and having the cash in my account. So that's something I'm considering. I don't have to make a decision today, but.
Yeah, it's awesome. And one little thing I wanted to draw out of your story, you talk about how you've got your contacts and they know, like, and trust you. They're taking a 6% rate of return, which for all intents and purposes may be well above 4.5%. What they might be getting if they're in a 10-year treasury, and yet at the same time, because they know you, they may not have taken that leap without you, right? And so I just love that's one of the aspects of real estate that I love. If you're a problem solver, if you look for solutions, you ask questions like, "What are you looking for? What are you going to do? Do with the money?" You can do some really, really amazing things for people.
Yeah,
And
no
then
question. I'm part of a exchangers group here in Indiana, and we actually just had a meeting this morning. And the wealth of knowledge and experience in that room is unbelievable. I'm so glad to be a part of it. And just some of the creative ways that people have come up with ways to finance properties, or how to dispose of properties and transact and trade properties, and where you can find debt and access to capital. There's so much to learn. And like, to your point, there really is just so many ways you can get creative in this business. If you stay out of the banks, you can really do some interesting things. Really, you can do anything you want. You just have to come to an agreement with another party.
absolutely. And which group is that? I think you said the Exchangers. I don't believe I've heard of them before.
Yeah, I think they're a national organization. My local branch, if you will, is the Indiana Indiana Real Estate Exchangers, Indiana Real Estate Exchangers, IREX, IREX. And I know they have one in Ohio and Kentucky. They're sister organizations to ours. But I believe they're a national organization. I want to say SEC, maybe Society of Exchange Council is the name of it. But it's been a very valuable resource for me, and I'm just getting started with these guys. But I'm probably the least experienced guy in the room most of the days when it comes to investors. There's lenders in there, there's property managers, there's contractors, there's realtors, commercial and residential. So you get a mix of people. But then you've got some investors in there that own 300,000 square feet of commercial space or whatever it might be. So it's kind of like a melting pot where individuals can go and collectively share ideas and figure out ways to get deals done.
Right, I love it. And then that's obviously focused on real estate. There's some benefits to that. And I'll just bring out another name. You may have heard of Business Networking or Business Network International.
Yes.
So, yeah, I don't know if I never actually gone to that group, but looking forward to doing that in the future. It's great because then you get the advantage of talking to people who might be outside of the real estate network. Who knows? They might be the person who loans you the money, or they, I mean, again, there you got your hard money lenders, and then you've got your sort of private money lenders. You might be able to find somebody again who's getting like a 1.6 on the 10-year treasury, and they'd really love to see 4, 5, 6 or even into the higher single digits. So now let's see, we touched on inflation, right? So you said, yeah, the government's printing some money, and maybe something's going to go wrong. These assets might not be worth what they were, so you want to go into real estate. So I would challenge you a little bit on the economy. So let's see how much money has been printed. My understanding is that at one point, over a few months of period, that's really hard to say this, but the amount of money was increased then by 40%, right? And that's shocking, right? I mean, how does the Fed increase the balance sheet like that, and we don't really see the inflation? We're starting to see it. So I want to ask you, what's your hypothesis on that? Where's the money going? And are we going to see that sort of hyperinflation we saw in the 1970s, or stagflation?
Well, I'm no economist, so let's put that as a precursor. But I think it's prudent as an investor to be concerned about that and keep your eye on the ball when it comes to these things. You hear Jerome Powell talk about how this is a transitory inflationary time where there's supply and demand dynamics that are out of whack because of supply chain disruptions within the COVID crisis, and you start to see these things kind of pop up a little bit here and there, and they're supposed to go away. So if you're betting that inflation is going to get out of control, you're kind of betting against the Fed knowing what they're doing, right? You're saying that they don't really know what they're saying, and this is going to get out of control, which to me is kind of a wait a minute, these guys are pretty smart. Let's give them somewhat of the benefit of the doubt. But if you look back in history, you see that this wouldn't be the first time that they've screwed things up if it does go awry. And some of these trends that are happening out there are not necessarily indicating that this is transitory whatsoever. There's a few things that I would anecdotally point to. In my experience, I was in an appliance store trying to buy refrigerators and stove oven combos for the units that we're fixing up in this apartment building. And in talking with them, they said, "You came in on the right day. We just got a shipment in." And I said, "Well, how much does this cost? Is there any negotiating because I'm buying in bulk?" And there was a little bit of wiggle room, but they had told me that their prices were about to go up June 1st. This was back probably at the end of April. That their suppliers, Frigidaire was one of them, had taken significant price bumps on raw materials that they used to build their appliances, and they could no longer absorb those costs. I think a lot of companies were putting off passing on any price increases that they were absorbing because the economy was a little bit fragile, right? But June 1st came and they were going to take an 8% price increase, and they were going to have to pass that on to the customer. So I said, "I'll take all the appliances I can buy from you guys today, and you can hold them in storage for me. That'd be great." So that was one example. Another example, a car. I need a new car. So I'm down at the dealership the other day. I'm talking with these guys, and used cars are in such high demand right now that you can get top dollar for used cars because the margins the dealership is going to make are huge. But you're not going to do much better because they can't supply new cars to buy from the manufacturers. So they're actually charging a $2,500, what do they call it, a market rate adjustment on any new cars. And they're not negotiating it because they know if I were to walk out the door and not say yes, the next guy behind me would come in and buy it. So that to me is interesting because the Fed and those economists that point to the CPI always argue that, well, the consumer price index shows that inflation's in control. Well, when you start to see things like car costs go up and rent go up, well, then those things do get reflected in the CPI, where other items may not necessarily show up or not reflected, which is why I think the CPI is kind of a bad metric as far as what inflation really is out there.
Like
But you've got supply.
fuel is not reflected. That's a big one.
Yeah, exactly. And you've got these other issues that are popping up in the economy right now where we pumped in all this money and we've given away free money to those that maybe needed it at a certain point, but at this point, I'd argue that there's no need anymore to continue to give charity money away. When we've got a Wendy's in Kentucky, I was driving from South Carolina back up to Indiana. We stopped in Kentucky. My kids were hungry and we didn't have any food left from what we packed in the morning on our long car drive. They wanted to stop at Wendy's. Sure, we pull up to use the inside to go to the restroom, and the doors are locked. And there's a big sign out that says that we're hiring. It's only the drive-through that's open, so they can't even staff the Wendy's because people are getting checks in the mail. They're not showing up to put in job applications. So what that is going to do is going to drive wages up because companies are going to have to give more away in the way of incentives or hourly pay or whatever to attract people to get up off their couch. So you're going to see wage inflation start to go up. So, am I an economist? Like I said, no, but I just think that it's prudent as an investor to kind of take note of these things and look at it and say, okay, how can I protect my portfolio from a situation where asset prices have already gone up and inflated? Now, what about consumer prices? What if those start to inflate? What is that going to look like for my portfolio? And when you think about all the different assets that you can use potentially to protect against inflation, people talk about gold or Bitcoin is the latest thing, which I think is nuts because a store of value shouldn't have volatility like Bitcoin does. So to me, that just makes
pure
no sense.
FOMO.
Yeah, exactly. That's a speculative asset. That's a greater fool game, in my opinion. Can you invest in it? Sure, but take it for what it is. It's kind of a gamble at this point. Gold has a longer track record, but it has really no exchange as a currency type use in today's society. It does tend to track inflation over the long term, but not very accurately in the short term, and it's subject to big, huge ups and downs and dips. And they don't pay income. Neither one of those assets do. So, bonds, we already talked about bonds and what the problem is there. There's no yield. So you come back to real estate. And it's not just that real estate pays income. It's that if inflation were to happen, rents will go up. So that's going to give you some protection. The price of the property itself. Will go up. And also, you get the benefits of leverage really shining through when you have an inflationary environment because the debt becomes cheaper to pay down in the future. If 10 years from now, prices are 20% higher than they are today, but you've got fixed rate debt that you locked in 10 years ago, well, that money is a lot cheaper in that future 10-year dollar amount value. So you're really getting a 20% discount on the debt you had 10 years prior. So for those reasons, I think real estate is a great inflation hedge. But in addition to that, you've also got great tax benefits, and you've got tenants that are building your equity for you. So it really is probably the best asset class in the world, I think.
I love it. And I think you hit on all of the notes there, right? I mean, you got more dollars chasing fewer items, right? Can't keep things in stock. We see commodities going up. Lumber, I'm in the construction industry. I could talk a lot about how lumber's been going up. It's nuts. And another thing that's not in that CPI is going to be housing, right? And that's, I think, where a lot of the dollars are going. I mean, you got to pay more money for housing. And obviously, what's that going to do to rents? I just love Neil Bawa. He likes to call that his 2-year crystal ball. Take a look at the residential environment, look at home prices, and in a couple of years, you're going to see similar increases in rents. So yeah, it's a very frightening time in this everything bubble. But I couldn't agree with you more. I'm 100% all in on real estate. I think everything's a bubble right now. But if I put it someplace, I'm not going to put it under my mattress. I'm gonna have to put in real estate.
Yeah, you might not be losing just 2% if you keep it in cash. It might be 4 or 5% in a couple of years.
Yeah, we don't know. And having lived through the Volcker era and stagflation, I have to tell you that I don't know what's going to happen when inflation starts, but I think we're not going to be able to put the genie back in the bottle. And I think we dodged a lot of bullets. And my expectation is that we're going to get to a certain point, and we're going to see real inflation. Not like 2.5, 3%. We're going to see real inflation, like you're saying. Yeah, you might be losing 2, you might be losing 3, 4, 5. We're going to see real inflation again, and we're going to find out just how this economic machine operates, right? I mean, I don't know if have you ever seen Ray Dalio's video on how the economic machine functions?
I have, yeah. I follow Ray Dalio on LinkedIn. I really enjoy his stuff. Yeah. He's brilliant. Yeah.
Yeah, he's just amazing. And I think that what we're going to see is that we've had this lower rate environment for a long time, and it's just going to take off. And I hope I'm
Well,
wrong.
I kind of hope you're wrong too. If you are right, I think what'll be interesting to see is how rates affect cap rates, and when balloon payments are due and loans need to be refinanced, who's going to be out there to lend money and at what rate, and do operators have enough in reserve to handle a rate shock, really? Because if inflation does get out of control, rates are going to go up. There's no question. So
Absolutely.
we'll see where it goes.
Right. Yeah. Liquidity, cash flow, going to be some pretty big things, multiple streams of income. Those are going to be the people who survive, the people who are thinking about cash flow. Yeah.
Right.
So anyway, I guess we can pivot away from the dismal science into
Please.
the last phase of the interview. This is all about entrepreneurship, Paul. So what I'd like to hear is just some of your philosophy on or about entrepreneurship and about how you're running your business. So what would you say, what is the next big step for Red Hawk Real Estate?
Yeah, good question. I mean, I'm enjoying what I'm doing right now. I certainly want to get this project that I have in hand operating and fully repositioned and turn it into a cash flow machine. But what I'm doing in the meantime is actively networking with guys like yourself, trying to get out there a little bit outside of the local community, just meet other operators, learn from them, potentially, help each other, whether that's through deal flow or providing capital or whatever else. I've been talking with other private investors and trying to build a list of people that are interested to invest either in joint ventures on a more active basis or in as limited partners to do a Reg D offering. So I haven't raised equity before in the past, but I do, from my prior connections, know quite a few people that are looking to get into the game, if you will. So I think I can, potentially bring capital into deals and potentially co-sponsor deals if it warranted that. But I feel like there's a lot of, like you had alluded to earlier, there's a lot of liquidity in the market right now. There are a lot of people chasing deals. It's become a lot more crowded of a space. So some of the prices that are assets are going for right now really don't pencil out to my criteria, to my risk tolerance. I'm finding that the space that really has a lot of opportunity potentially for me at this time is the mid-size apartment buildings and the workforce housing space. These are typically going to be older assets that need some value add injection, similar to the model that I'm deploying right now and have been successful in the past. But also we have an affordable housing crisis, and there's not a lot of stuff out there available for people that are making a middle to lower income wage. So the stuff gets snatched up like that in the markets that I'm operating in. You put it out there and it's immediately rented. So that's a good thing. I really feel like you have to have profit and progress meet. Like, you can't provide free housing for everybody. There's got to be money involved for those that are putting the money in to get a return. So if you can marry those two things up, you can really make an impact both socially as well as from a return standpoint. And I think with those mid-sized buildings, there's less competition. There's more mom and pop operators. So you've got some inefficiencies from an operational standpoint. You go in there and you turn around those things, as well as pump some money into it where you can raise rents up and still make it affordable to the community that needs it. That's where profit meets progress. So that's my goal, is to really get more involved in those types of properties, bring in other JV partners to work with me to go after bigger deals. And if it's big enough, then get into the syndication game.
Yeah, I love it. Exciting. Yeah, getting that Reg D is a big deal. And then maybe a fund or something. Is that a goal for you?
I don't know
Something
about a
like it.
fund. I'm a
Yeah.
passive investor too, and I am invested in one fund, but I kind of like the single asset model a little bit better because you can underwrite each individual deal as opposed to a blind pool fund where you just put it in, or if it's diversified a bunch of properties. I don't know. Sometimes I like to just invest in a REIT where I've got more liquidity for that specific purpose. So I don't know. And then obviously you've got some regulatory challenges. It's much more difficult to structure a fund than a single asset syndication. So I would probably lean towards a single asset.
Cool. And then, one thing actually I forgot to hit on is that you actually own a part of 1,300 Doors as a passive investor. So I understand you have holdings in multifamily, ATMs, as well as industrial. So maybe talk a little bit about that.
Yeah, sure. Well, I think passive investing is fantastic. I mean, that's kind of where I want to end up, let's call it 15, 20 years from now, where I'm not doing any of the work. I'm not dealing with tenants, toilets, contractors, brokers. I'm not trying to acquire. I've just married up to a couple of good sponsors that I know, like, and trust, who I know can make me a return and just ride on their coattails. I mean, that is the name of the game, to earn a good cash on cash return and have some upside appreciation passively, bingo. So I put a fair bit of my net worth into passive investments when I left W2 work, really because I wanted to learn the syndication model and understand it as a limited partner. What was important to me as an investor, and talking with sponsors and seeing how they kind of deal with their partners or their limited partners, people they're trying to raise capital from. But also, I wanted geographic diversification because I'm in the Midwest and it's really a cash flow play in the Midwest, right? We're seeing some more appreciation these days, but typically, historically, it's been more of a cash flow region. Whereas you go into areas of the South, Texas, Arizona, Florida, wherever it might be, you're seeing a lot of appreciation in those markets because you've got net migration happening from the Northeast, from the colder parts of the world. People are realizing now after COVID that they can kind of work wherever they want to. So they're going to places that are more destination vacation style towns. So these areas are booming, and not only are rents going up faster there than they are in my neck of the woods, on the exit, the appreciation is going to be there. So I wanted to get involved in that area of the market or that area of the country. And obviously I don't have a footprint down there. I don't have a team. I'm not local. So it just made sense to invest passively.
Yeah, I love it. I love it. And so now I believe you're looking more towards Southern Indiana
From an active standpoint,
from an active
yes,
standpoint.
yeah,
Yes.
yeah. I'm in Indianapolis. I went down to Evansville. I felt like the numbers were starting to pencil out less and less the way I wanted them to in Indianapolis as the space got more crowded and we had more out-of-state investors coming. So from
Yeah.
the active side, I was looking at tertiary markets that I could get to and back within a day's drive. And I looked at 4 or 5 different markets and I found Evansville, Indiana. And it was really because of a relationship that I was able to develop down there. I met a property manager who had a general contracting license, and his father actually runs that side of the business. So we started with a single family home, a light rehab, went through the whole thing. I acquired it. They fixed it up. They put it on the market, leased it up. And I still got the same tenant in there today. We did really well on that deal. So that was just kind of a launching pad. And we did 2 more, then it was 6 more. And then we did a lot of single family and small multifamilies and stuff that I talked about prior in the conversation. And it turns out that he actually was familiar with the apartment that I was acquiring. So as I'm going through this reposition process, I've got, somebody on my team who's very familiar with the property and can kind of help with some historical stuff and, is a good partner in the process. So having that relationship is huge. I mean, I wouldn't go into any market without having some pre-existing relationship with a property manager, another investor who I could trust that knows a property manager. That's probably the most important person you're going to have on your team, especially if you're out of market.
I love it. Get your team together, get your boots on the ground. All right. So then again, with passive investing, I understand that you're writing articles over at Left Field Investors, in addition to your blog at Red Hawk Real Estate.
That's right. Yeah, my website is Red Hawk Investing, and I also do some writing for Left Field Investors. If you guys haven't checked it out, Left Field Investors is an awesome group. If you're interested in investing passively, it's a community of passive investors that basically bounce ideas off each other, word of mouth, share experiences with sponsors. They analyze deals and how to analyze deals. It's a resource from a website standpoint. If you go to leftfieldinvestors.com, they've got a ton of articles. They've got calculators. It's well worth it. And one of the guys that runs it does a monthly Zoom meetup. So it's a way to connect with other passive investors. As a passive investor, it's a benefit to me, but as an active investor too, it's a lot of individuals that could potentially be partners down the road from that standpoint. So really nice benefit in that group, and I love what they're doing over there.
So I love it. Let me ask you a couple more questions about entrepreneurship. So who's been the greatest influence on your entrepreneurial career?
Wow, that is a good question. Greatest influence on my entrepreneurial career. I got to phone a friend on that one. I don't know. Let's skip that one.
Okay. All right. That's fair. I like it. I like it. All right. How about this? Advice you would give a new entrepreneur or maybe to your younger self?
To my younger self, I would say, get off your hands and get out there and start doing it. stop analyzing and overdoing the analysis paralysis. That was really, I think, one of the biggest issues I had, was that I was always worried, because I didn't have a construction background, or I'd never managed a property before, that I was going to have a total loss if I were to buy something in real estate. That if I paid $50,000 in cash for something, it was going to be gone and liquidated and vaporized forever. The fact of the matter is that's not true. I mean, you can mitigate your risk by understanding, by educating yourself. And then if you make a bad decision in real estate, the good news is that you're not going to lose all your money. You probably won't lose anything if you wait it out long enough, because you're going to be collecting rent. Your property is probably going to be appreciating. So instead of, if you had a plan to, sell it in a year, it might be 3 or 4 years, but you're not going to have a total loss. So I think I would just tell myself to get out there, start doing it sooner. If I had done that, I don't know where I would be today. But if I had started this in 2014, when I was really starting to think about doing it, my business would be a lot farther along than it would be today. And then I would also say, to anybody that's aspiring to invest in real estate, to not speculate. I mean, especially in today's market, it's difficult to find deals. There's no question. They're still out there, but don't force a square peg through a round hole. If 4 or 5 things have to go right to make it a good deal, or you're like, oh, I don't know anything about that, but I'm just going to let it ride and hope it works out. That's where you get in trouble. If you buy a cash flowing asset that cash flows from day one, it's very unlikely that you're going to get in such trouble that you end up losing the property. So I would say that, and just have a lot of reserves, and just take a chance on yourself. It's always like, when it just comes to entrepreneurship in general, it's just putting one foot in front of the other. It's day by day, taking small steps, taking small bites, and seeing what comes of it. You're going to fail. You're not going to have every day be a success. Not everything is going to work perfectly. But if you're really committed to what you're doing, and you're really passionate about what you're doing, which you should be if you're going to be an entrepreneur in anything, then you just keep going, and you keep progressing. You keep talking to people. You keep building on the momentum that you have. It may take a while, but things will likely turn out the way you want them to if you just don't quit.
I love it. Absolutely great advice. Paul, I want to thank you for coming on the show, and just send us out with a quick, how do we connect with Paul?
Great. Yeah, George. Hey, it's been an honor to be on your show. I really appreciate it. It's been good talking to you. People can connect with me at www.redhawkinvesting.com. I'm also pretty active on LinkedIn, and you can find me there.
All right, great. Redhawkinvesting.com. Thank you.
Thanks, George.